Hi, Harry here for the Rant on July 28th. I will tell you something right here. This is the most extreme situation I think I've seen in my career when it comes to monetary policy. And nobody wants to see that fail more than me because it's been more abused and overused or anything you want to describe it in all of history. We have to remember, for 14 years we've been living off of stimulus since the 2008-9 downturn and crash, which I called decades in advance, not years or months, okay? It was just the peak of the baby boom spending wave, turning to a slower economy for 14 years into about now. So this is why we've lived off of over $8 trillion just in monetary stimulus, not to count the trillions in fiscal, okay? And 5.2 trillion just since COVID into early last year when they finally started to tighten. 5.2 trillion out of that net over 8 trillion came in 2 years over a short-term virus, for crying out loud, that would go away like the influenza of 1918 and 1920. This has happened before. So extreme stimulus, and we go from inflation that's been falling and low forever. I haven't been predicting inflation, right? With all this growth we've had low inflation and high growth, just like the Roaring '20s and other times of strong demographics, and the demographics give us spending growth and productivity growth and efficiency, okay, as people age and stuff. So we've been in a Goldilocks economy. But 2008 and 9 hit and the Fed panicked. They panicked. They started that first $1 trillion in stimulus thinking that would be enough. And what happens with an endless slowdown for demographics that economists and most investors don't understand? It takes more and more and more stimulus until the balance sheet rises to almost 9 trillion, and we've added over 8 trillion in stimulus over 14 years. And again, most of that in the last two up to last March when they finally started to tighten. And now, after printing that $5.2 trillion in 2 years, which is still making its way into the economy because it's such a large lump and there's a lag. And the lag's always 1 year, maybe 18 months, but when you put that much money in, you know the lag's gonna be longer. So we're still feeling that huge stimulus, but then they also said, oops, we gotta tighten now because inflation suddenly went from 1 to 2% to 9.1%, which was totally created by that massive money printing in 2 years. That's what do you expect when you print that much? Again, printing money forever, no big inflation. Why? Productivity's been so strong, okay? All things we predicted. So here's the dilemma. You get this strong surge still hitting, but not. It's going to wear off. It was artificial. It's not real. And this tightening, which started last year, but is just getting near likely a peak at 525 basis points, 5.25% raise, and it's probably going to go to 5.5. It could go longer than that. But we're towards the end of that, but that's going to keep hitting for the next year plus. So we have a wear off of the biggest short-term stimulus, bam, and then the tightening, bam, all going to hit in the next year. And especially in the next 6 months for the stimulus wearing off. So I don't know why the markets are so confused here. What the markets are actually pricing in is a perfect soft landing. First of all, we've never had a soft landing. It's never worked. You don't have a long boom and let too much debt build up and excesses and bubbles and all this sort of stuff and have a soft landing. There's no way to have a soft landing. This is the second of two of the greatest bubbles in all of history. The first one did finally deflate between 2000 and 2002. First stocks, and then on a lag, real estate. And now we had them both bubble, and stocks have started their first wave of deflating this bubble. Real estate's just barely starting. So we have to deflate this bubble. And the time to happen is over the next couple years. And Deflating bubbles can only mean stocks go down, real estate goes down, unemployment goes up. This is going to be the biggest hit the economy's seen in our lifetimes, okay? So again, that's what we're looking at, the battle of the lags. Now I'm telling you, if you're thinking about maybe this is a good time to subscribe to my real newsletter, 15 to 20 pages a month and real updates every time something changes, this is the time, folks, okay? Because this is when it's gonna hit, and it's gonna be some of the biggest surprises in history. Tell you right now, that the treasury bonds, they're the safe haven. What are they doing going down in value? They've been in a trading range that we've been showing in the newsletter between 99 and 109, and they're back at 99. If they break below that, it means growth is going to be higher than expected. Inflation is going to be higher than expected. And that's not good. That means they're going to have to tighten harder, okay? But I think it's way more likely. In fact, it's a great time to buy TLT that people had. My last buy signal was at 97 for subscribers. This is a great time to buy because if it breaks up through this $10 trading range above 109, my projection's 186 plus. I'm telling you, the treasury bonds have never, ever in a couple of years seen a rally of this magnitude. So I mean, and not even in extreme situations like in the 30s when stocks went down more. So we have an extreme bullish move here that wants to make this move, and the markets are faking. Oh, I'm not going to do it. This move has got to happen. Economy's got to slow because the Fed's got to keep tightening if it doesn't slow enough. Okay, and they've said they will. Okay, stocks, same thing. Okay. They finally took a first crash that said this bubble's very likely over, okay? But now they bounced almost back within 5 to 10% of the all-time highs. How can you explain this when they just raised interest rates 525 basis points, much higher than in 2000 into 2006 before the last great crash and the biggest downturn since the early 80s and the Great Depression? People just aren't thinking here. The markets are beyond on crack at this point. So we are looking for the same scenario, and particularly into 2024. Stocks have to go into the next wave of the crash, what I call the third wave down. I think they're about to start that finally. They've been hesitating. They don't want to. They want to fake everybody out. And these treasury bonds are going to see, as I just said, the biggest rally ever in history, and ever you or your kids will ever see in the decades ahead, is likely to happen in the next year or two. We're seeing stocks are going to have to go down hard soon, and these treasury bonds are going to start their safe haven rally, which will be the greatest in history. So this is a huge time to be awake. This is the time to be listening to outsiders like me, okay, that have been warning about all of this, and now it's happening, and you can't believe, oh, well, they put it up so far. You can't fight a trend this big. No bubble in all of history has ever not burst. Never one. Send me one, and I'll kiss your ass in public, okay? That's all I can say here. Bubbles burst. So, and they put this off as long as they can, and again, the great mistake, I call it, okay? They over-goosed when the short-term COVID hit, which forced them to finally over-tighten. The big illusion right now, folks, and it's not going to take long to prove this, the markets think that the economy is fundamentally strong and if anything needs to be restrained. And of course, the Feds have that bias. This is not true. Where we are on the best long-term indicator I've had for decades, the spending wave in the US and around the world, we're at the bottom of the baby bust slowdown. Why do you think we had to print $8 trillion over 14 years? That alone creates over 3% growth a year, and that means without all this stimulus we've seen in the last 14 years, we would have had a zero growth economy at best. Oh, the only time in history that was 1930 to 38, the Great Depression. So this is crystal clear to me, folks. It is being mirrored by all this smoke and mirrors and it's over stimulus and now over tightening. This can only play out one way. The biggest stimulus short term in history, 5.2 trillion, falls like a rock in the next year, and this tightening starts to hit harder and harder also in this next year. And the market stocks are down into mid to late 2024 and big time very likely, and the treasury bonds will be the only clear safe thing to buy that'll go up, okay? Not gold. Gold will go down as it did in 2008, okay? It'll wait, just like it's been waiting. It will go down in the end too, probably about 50%, probably to 900,000, not the worst place to be. This is about getting out of stocks or shorting stocks of your trader and buying the highest quality bonds in the earth. I don't care how big a debt problem we have. We have better debt ratios in a bad neighborhood than Europe and Japan and Asia are our neighbors. And China is the greatest debt bubble in the world this time, and everybody thinks they're king. China's going to do nothing but lose population and shrink in the next 50 years and see the biggest debt and real estate bubble in history burst. And China is already leading this. I'm covering that in the current issue that's going to come out on Monday of the HS Dent forecast. Folks, if you're thinking of spending a little money and getting more information in the next year, which may be the most important time in our lifetimes, I would recommend, I'm tooting my own horn here, subscribe to our newsletter. Take a risk for 1 year if you're not already on. Okay, so folks, I'll keep you updated.